viewers, I'm here to share with you about market updates. Today we're going to be talking about Janet Yellen's trip to China and her response to the relationship between the US and China, and also the impact of the rising interest rates. Yellen ended her visits to China and held a press conference in Beijing, reiterating that the US should not seek a decoupling from China in terms of economic relationships. At the end of the 4-day trip to China, U.S. Treasury Secretary Janet Yellen held a press conference in Beijing. She said her meeting with senior Chinese officials in recent days were direct and productive and helped stabilize the relationship between the two countries. According to the report, Yellen said in a press conference that the purpose of the visit to China is to establish and deepen the relationship with the new economic team of the Chinese side, reducing the risk of misunderstanding, and pave the way for future cooperation between the two countries in areas such as climate change and debt crisis. On Friday, the blowing non-farm payrolls data did not dampen investors' panic about rate hikes, with larger than expected wave increases, leaving many investors pricing in Fed's July plus fundamentals. U.S. bond quickly lowered after the data, with the 10 and 30-year yields rising to their highest level this year. At the same time, yields on the inflation-protected bonds are soaring. The nominal interest rate on the benchmark 10-year U.S. Treasury note, known as the 10-year inflation-protected bonds, or TIPS, to 1.82% on Friday, the highest level since 2009. Since the real interest rate and inflation expectations cannot be directly observed, the nominal yield of the TIPS is commonly used in practice to measure the real interest rate in the U.S., and the difference between nominal yield of the Treasury bonds of the same term and the yields of the TIPS is the break-even inflation rate, which is regarded as the implied inflation expectation of the market. The real interest rate is usually representing the real investment income of the real economy and the real financing cost of enterprises, which has an important impact on the behavior of micro-subjects. The allocation of financial resources and asset pricing has been widely concerned by policymakers and market participants. Higher real yield on ultra-low risk security Treasury will make other assets less attractive, while higher borrowing costs will have a negative impact on the corporate sector. Rising interest rate means that companies used to be able to borrow at or near zero real interest rate are now paying much higher price. For example, during 2021, a typical high-yield company was able to raise capital at an interest rate about 4% and will now have to pay more than 12%. Funding standards are also tightening, putting further pressure on equity evaluations. Fidelity International data shows that the new loans issued by the U.S. banks so far this year are equivalent to an annualized rate of $279 billion, down from the average of $481 billion between 2015 and 2019. Against the backdrop of soaring interest rates, real interest rate, if the Fed continues to raise interest rate, it will greatly increase the risk of a hard landing. At the present, the market has fully priced in the July rate hike, according to the CME FedWatch tool. The fund market currently sees a 93.0% chance of a July interest rate hike. The better-than-expected wage growth rate in the labor market and the hawkish signs from the Federal Reserve sent a broader market lower on Friday. However, many analysts noted that the valuations are still quite high, and the investors are pricing in a sharp pullback in real interest rates next year. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.